Been taking a strong focus on the equities markets lately, but it seems the action is actually on the bonds and fixed income front, with some interesting developments expected within the next few weeks. Joining us in studio now to take us through the latest on the fixed income market is Fred Moturi, a fund manager with Sterling Investment Bank. Thanks for joining us.
Thank you, Terryanne.
How's the action on the fixed income front lately? Has the sideways movement on the equities positively impacted the bonds market?
Yeah, thank you, Terryanne. Actually, interesting the way you framed the first comment. Actually, we've seen a significant increase in secondary trading of fixed income instruments in the Nairobi Stock Exchange. Interesting to note, today we hit an all-time high of 8.3 billion shillings. Being traded in an Nairobi Stock Exchange just today alone. Though partly it was attributed to slow trading yesterday due to some small technical hiccup which slowed down trading, but it is important to note that we've never traded such huge volumes of bonds like we did today.
Let's talk about the interesting developments now, and that's of course the 25-year bond that is expected into the market. The longest bond we have currently is a 20-year old one. Stakeholders seem to be keen on deepening the capital markets. What's the latest on that front?
Actually, yesterday the Market Leaders Forum sat and proposed a 25-year bond to be issued in this month, and the government wants to offer about 7.5 billion. What we need to know here is that 7.5 billion appears to be a little less than what the market can absorb. The market can absorb a little bit more than that because we have maturities more than 6 billion in this month. For the government to come and offer 7.5 billion for a long paper like that, we are likely to see a decline in interest rates yet again.
Okay. Yes. Now, with that new entry, of course, the government will be able to access longer-term financing. But coming to the investors themselves, who've been taking a stronger focus on the fixed income market, especially within the last 2 years, is a 25-year-old yield curve attractive to investors?
There are several ways to look at it. First of all, you need to know that because the inflation rate has been declining in the past few months, this year especially, the required rate of return from investors has been declining at the same time because total return is likely to be positive. On the short end, we've been seeing much more steeper decline in interest rates. And that's why we are finding investors favoring medium to longer term bonds. And hence a 25-year is likely to be attractive to quite a sizable chunk of investors.
Now already we know the market can absorb substantial debt, and as you have just mentioned earlier, with budget day coming, do you expect the government to raise more capital locally?
It is likely that they may, this current financial year, the government, I think, have learned that the market is deep enough to absorb more debt than they thought. Previously, they thought 109 was a bit on a stretch. They increased it to 124 billion. They got all the 124 billion last month. This month, they're just going to collect 7.5 billion, which means the government, the market can absorb more. We wait to see, but it's likely the government may favor primary auction as a means of raising funds for infrastructure, and is likely to come at a cheaper cost.
Okay, so what if it does not decide to borrow locally? There's been talk of the sovereign bond, and analysts are hoping that Finance Minister Uhuru Kenyatta will finally say a word whether the government is still keen on offering a sovereign bond or putting it locally.
Several factors come into play when you want to offer sovereign bond. You have to factor in foreign exchange risk. You have to factor in your ratings as a country, your ratings factors that affect the ratings, a number of them political risk, for example, which the government may not have direct control over. When you have an alternative of local financing that from the primary, I would imagine it's cheaper and easier to raise local cash than raising foreign debt.
How about infrastructure bonds? Development finance seems to be the trend that the government is heading towards. The interest rates seem pretty good. It is a tax-free bond. Do you see us heading in that direction?
Possibly, it's possible because, but we have to know that it favors mostly the investor who buys, because the investor who holds the bond and it's tax-free. So the taxable, tax equivalent rate of return is much higher than other equivalent bonds. But the interest rates or the coupon which the government will pay is more likely to stay the same. Government will have to weigh the foregone interest on withholding tax and corporate tax. They will forego in issuing of infrastructure bond vis-a-vis making it attractive for investors to buy. Those two factors come into play.